Hello and welcome to the Financial Future Guide. I'm your guy and I'm your guide. My name is Alex, and today we're looking at two companies that we have discussed on this channel before. However, I know there's a lot of new investors in the market. I see it in the forums, I see it on Facebook groups, so I wanted to discuss two really great core holdings that I think anyone would welcome into their portfolio. Both of these companies have strong dividend growth, and I would expect them to have great opportunity for capital appreciation in the future. Now, if you're new to the channel but enjoy content such as stock news, discussion, and analysis, here's the perfect place to get started. Go ahead and hit subscribe. Welcome to the community. Alright, we have a lot to get through today, so let's get started. Now, the first stock for today is Telus, ticker symbol T on Canadian exchanges or TU on the US exchanges. They currently have a dividend yield of 4.73% or $1.24 Canadian. Telus is one of the big three telecommunications companies in Canada, competing with Bell and Rogers. Now, some people choose to hold multiple telecom companies within their portfolio, but if you had to go with just one, I do believe that Telus would be the best fit for that position. Looking at Telus' stock chart, we can see that their last 10 years have rewarded shareholders very nicely, up around about 200% from 2010. On the 1-year chart, Telus did have that sell-off in March, just like anyone else, but since then it has been on quite a nice gradual uphill trend. As I mentioned before, I have done a full in-depth analysis on both of the companies I'll be talking about today, where we go into some more of the finer details. If this video sparks up any interest in either of these companies, I do definitely recommend you go and check out my full analysis, as it'll definitely give you a little bit of a better understanding of the company. Anyway, as a quick summary for Telus, they have 15.2 million customers, and they offer a large range of services. This includes everything from internet, mobile, and home phone services. They have a media division. They have Telus International, which is a business solutions provider that actually spun off and IPO'd itself a few weeks ago. However, Telus does still own the majority of this company. They have Telus Health, and that's their play at the telemedicine space. And finally, they offer security solutions. I'll leave it at that for this video, but in the full analysis, I do go into depth on each one of these business segments. It's quite evident by the opportunities that Telus has been chasing that they are quite a forward-thinking company, and I would definitely say that they're the most innovative of the big three telecommunications companies. Telus International is mainly focused on helping companies digitally integrate. Babylon is one of the projects by Telus Health, in which they're aiming to digitalize the health sector. They've formed a recent partnership with Google Cloud, and through their security sector, they're continuing to develop the idea of smart homes. It's quite obvious that as technology continues to evolve, companies that aren't innovative tend to fall behind. With Telus branching out and going down different avenues, they should be able to continue to grow as a company. If we look at the management team, they're led by none other Darren Entwistle, and he's been president and CEO of the company for over 21 years. His leadership has guided Telus in the right direction, and the success of this has led to strong results for shareholders. Taking a look at some of Philtown's main management Rule 1 numbers, we can see that they've had incredibly strong return on equity of 15.7% over the last 10 years, and that's still fairly strong in the last 3 years at 14%. Their return on invested capital averaged 7.3% over the last 10 years and 5.7% in the 3-year. The return on invested capital isn't anything to get too excited about. However, it's not that bad for a capital-intensive industry like telecommunications. Taking a look at the stock quote today, just note that everything here is in Canadian dollars, and Telus' stock closed on Friday at $26.06, down 28 cents on the day, or 1.06%. They have a market cap of $33.8 billion, a PE ratio over the trailing 12 months of 27.72, and earnings per share of 94 cents in the same period. Over the course of the year, the company has traded anywhere between $18.55 and $27.54. And as we saw before, they pay that annual dividend of $1.24 Canadian, which equates to 4.73% of the current stock price. Now, Telus has actually grown that dividend for the last 15 years, and in the last 5 years had a compounded average growth rate of 8.7%. Back in 2010, they were paying 50 cents per share, which equated to a 5% yield on the stock price at that time, and now we're at $1.24. Now, looking at this chart, what we see is fairly steady growth, quite consistent over the past 10 years, and this means that the company is annually increasing their dividend. Now, Simply Wall Street, which is a great tool for all investors, offers an estimated fair value based on the cash flows the company is expected to generate in the future. Their fair value estimate for Telus is $54.14, So based on this metric, they believe that Telus is 51.9% undervalued. Taking a look at the price to book ratio, Telus is currently trading at a 2.8 multiple, which as stated below that is in line with the industry average. As always, I like to go and have a peep at some of the other large players in the industry, and we can see that Rogers and Bell are both trading at a 2.9 price to book ratio, so Telus does appear to be trading around the same multiple as their two largest competitors. Next up, we'll look at the recent insider trading, and I think this is a great way to look into the window of a company and see what those that are a part of the management and the board think of the current stock price. So for Telus, we have a little bit of both, but definitely heavier on the buy side. We have a few key members of management and directors making some quite substantial buys in the last few months. Now we can see the most two recent trades are both sells, but only of values of $21,000 and $65,000. I believe that it was Peter Lynch that once said, people will sell a stock for any reason, but they will buy for only one. So what I'm trying to say is I put a lot more of the importance on recent insider buying than I do recent insider selling. Overall, I would say looking at this for Telus, we're seeing quite a positive story, including three key members making quite substantial buys ranging anywhere from $114,000 to just shy of $500,000 in the first week of December. Following on from that, we'll take a look at the ownership of the company, and what we're seeing with Telus is quite strong insider ownership. Here we have 5 key members of the executive team with no less than $2.5 million invested in Telus. With their own capital on the line, this is fairly positive and quite reassuring that those that are at the top making the decisions are doing it with the best interests of long-term shareholders. In conclusion, I believe that Telus is the #1 telecommunications company within Canada. I myself sold out my full position in Bell to double down on Telus. Now I'm not saying that there's anything wrong with having multiple players within this sector, I just personally believe in the management of Telus and the way that they're positioning themselves for long-term growth. Let me know below if Telus is your Canadian telecommunications pick, but if it's not, tell me who you've picked in this sector, and I would love to hear your reasoning why. So that's it, pick #1 for me today is Telus. Pick #2 is another large, well-known Canadian company that I've covered on the channel, and that is Toronto Dominion Bank, commonly known as TD Bank. They trade under the ticker symbol TD on both Canadian and US exchanges. They currently have a dividend yield of 4.14% as they're paying an annual dividend of $3.16 Canadian. Now much like Telus, TD is one of the big players in their industry alongside the 4 other large banks. I am a big fan of the Canadian financial sector and they are very well regulated, providing some safety to investors. I think that you can't really go wrong with any of the big 5. However, I personally believe that RBC, ticker symbol RY, and TD Bank are the clear winners within the industry. TD Bank has had a very impressive run over the last 5 years. They obviously fell sharply in the March sell-off, but has now recovered to close to all-time highs. TD Bank is focused on the North American market with 2,308 locations across North America. They also have the other segment of their business, TD Securities, with 15 offices worldwide. They currently have 21% of the Canadian market share, and although they're not yet a leader, they have a growing US presence. Their earnings are drawn from a number of different services, with the bulk coming out of the Canadian retail market at 58%, the US retail at 18%, TD Arbitrade at 10%, and then their wholesale banking at 14%. I believe TD has a very interesting growth strategy that's a little bit different to some of the other large banks. They have 14.5 million active digital customers, and then through their mobile applications, they have 5.9 million active Canadians and 3.7 million active US citizens. They run services such as TD Goal Assist. This is a mobile service from TD Direct Investing, which allows Canadians to plan, invest, and monitor their financial goals. They offer services such as stock trading, commission-free TD ETFs, and require no investment minimums or monthly fees. I'm quite drawn to TD's focus on the broker side, as I think this is a great industry to be in, and some of their recent moves have proven how committed they are to be leaders within this industry. You may have guessed it, but I'm talking about their Charles Schwab deal. Now this was a deal where Charles Schwab completed the acquisition of TD Arbitrade. This acquisition created a company that is now worth about $6 trillion in client assets across 28 million brokerage accounts. They'll be integrating these two companies' operations together over the next 1.5 to 3 years. From the sale, TD Bank now owns approximately 13.5% of Charles Schwab. They also expect to record a huge gain of approximately $2.3 billion based on Charles Schwab's share price and the impact of certain adjustments. Prior to this acquisition, TD Ameritrade and Charles Schwab were both individually one of the 5 largest broker firms in the US. Now, as a combined company, they will be the largest broker in the North American market. Now, these are decisions that would only be made by a very strong management team. TD is led by Mr. Masrani, who is the president and CEO of the TD Bank Group. Mr. Masrani was appointed Group President and CEO of TD Bank Group on November 1st, 2014. He has more than 27 years of banking experience and prior to this role served as the Chief Operating Officer for TD Bank Group. Now, their management team has performed very well over the last few years, and if we have a look at Phil Town's management numbers, they really are quite astounding. We have an average rate of return on equity of 14.2% for both the 10 and the 3-year, return on invested capital at 11.5% for the 10-year, and 10.7% for the 3-year. These numbers really do show that this management team knows exactly what they're doing when it comes to making decisions for the company. Cruising on over to the stock price today, they closed at $76.38, up 88 cents or 1.17% on the day. They have a market cap of $138.676 billion, and they're trading at a PE ratio over the trailing 12 months of 11.88. Their earnings per share is $6.43 over the same time period. Their 52-week range is anywhere from $49.01 and $76.68. We can see that we're trading right at the top of this range now, as TD is now moving on to all-time highs. They're currently paying a dividend of $3.16, which comes to a very sexy 4.14% dividend yield. Their dividend has experienced some nice growth over the last decade, as back in 2010, they were paying $1.22 per share, which equated to 3.3% of the stock price at the time, and that has now grown to $3.16. And what you'll also notice here by this green line is in the last 5 years, that dividend dollar value has increased quite substantially. They have a 5-year compounded annual growth rate of 8.73%. If we have a look at their share price versus fair value, Simply Wall Street has given TD a fair value of $83.62, meaning that the stock is currently 8.7% undervalued. Moving on to the price to book ratio, TD currently trades at a multiple of 1.5, which is a little bit higher than industry average, so let's take a look at some competitors. We have Scotiabank at a 1.3 multiple and RBC at a 1.9 multiple. So this means that TD is sitting around about the middle of the pack for this metric. Taking a look at the recent insider trading for TD, there hasn't been a lot of activity over the last 12 months. I think the main thing to address here is Mark Chauvin, who sold a stake of about 3.3 million Canadian dollars in the second week of January. Now, Mark used to be a member of the TD management team, however he did leave 4 years ago into retirement. For that reason, him cashing out $3.3 million isn't anything to be alarmed about in my opinion. Concluding with the ownership, we can see that TD Bank does indeed have a decent amount of insider ownership. President and CEO Mr. Masrani has a $64 million stake within the company, and we can see that the directors also have some decent positions. So that will conclude my second pick for today. Again, these were not wild picks. This wasn't your next Tesla, and it definitely wasn't your next e-hang. However, I believe that both these companies are key puzzle pieces for any dividend growth investor, and I hope that you took something away from this video and maybe came up with a few investment ideas. Do you own any of the big banks? Is the big banks how you play the financial sector? Let me know what you're doing in this space over in the comment section below. Alright, so that concludes today's episode. Remember to do all your own research prior to investing in any of these companies. And don't forget to like, comment, and subscribe to see videos similar to this one. And tell your friends.